In 48 hours, the silver market did something that, in calmer years, gets described as impossible right up until it happens. Prices surged to roughly $121, then collapsed toward 64, erasing a giant chunk of value with the kind of violence that forces exchanges to slam on the brakes. That's not a normal pullback. That's the market telling you that leverage, collateral, and expectations are colliding all at once. What makes it more unsettling is that the most important move didn't happen on your screen, it happened in the plumbing. While most people were watching the headline price, the collateral rules quietly changed, and when collateral rules change, behavior changes. Margin is the hidden gravity in futures markets. Raise it fast and you can turn eager buyers into forced sellers overnight, not because they changed their mind, but because they ran out of room. And here's the part that breaks normal expectations. Even as silver was falling in a way that should have scared money away, a wave of cash ran toward it. Hundreds of millions of dollars flowed into the largest silver ETF in a handful of sessions, including more than $100 million on a single day when price fell about 27%. If that sounds contradictory, good. Contradictions are where the real information lives. They said inflation expectations were settling down. They said rates had done the job. Yet the market's behavior looks like the opposite. A system still sensitive to inflation risk, still vulnerable to liquidity shocks, and still capable of repricing real assets in a hurry. Institutions already know how these episodes rhyme because they've seen the pattern before. Most people only find out when it shows up on the recap. What I'm about to lay out is not opinion, and it isn't a prediction. It's the pattern, the numbers, and the dislocations widening right now. Once you see how the pieces fit, you can't unsee it. Welcome to Signal and Silver, where we decode what matters before it becomes a headline. If you like analysis that stays calm, stays grounded in data, and connects the dots most people miss, you're in the right place. Think of subscribing like keeping a wise elder in your corner. And tell me in the comments where you're watching from, because markets are global and the crowd often senses stress early. Now, let's reconstruct what actually happened with the kind of detail that reveals motive, not just motion. The price spike and crash didn't occur in a vacuum. It was accompanied by institutional responses you only see when risk managers are tightening belts. On January 31st, 2026, the CME raised margins on COMEX silver futures. The baseline margin requirement rose to 15% from 11%, and the heightened risk category increased to 16.5% from about 12.1%. That's not a cosmetic tweak. Exchanges do not do this for drama. They do it to protect the clearing system, because if the clearing system fails, the whole market fails. To understand why that matters, picture the futures market as a highway where leverage is the speed limit. When the exchange lowers the speed limit, cars don't slow down politely. Some crash because they were built to go faster. A trader who could hold a position yesterday suddenly has to post more collateral today. If they don't have it, they sell. If enough participants are forced to sell at the same time, price doesn't glide down. It falls through air pockets. Margin changes also tend to arrive after positioning gets stretched and volatility has already exploded. In other words, the response is reactive, which means it often lands when the market is already fragile. That timing matters because it turns what would have been a sharp move into a cascade. Then you look at the ETF flows and you realize there are two stories running in parallel. About $430 million flowed into the biggest silver ETF over 6 trading days through February 5th, 2026. That includes more than $100 million on January 30th. The same day price collapsed about 27%. That is a bid in size into chaos. It's the market saying the drop might be about liquidity, not about value. Meanwhile, across the Pacific, a different kind of positioning was unfolding. Reports described a major Chinese trading firm building a huge short on the Shanghai futures exchange on the order of roughly 484 tons, valued at more than $1.5 billion, and profiting around $519 million as price fell. The message is simple. Large players were active, directional, and early. They weren't guessing. They were managing exposure with scale. And while all of this was happening, inflation expectations were sending mixed signals. The New York Fed's survey of consumer expectations showed median one-year inflation expectations at 3.1% in January 2026, down from the prior month, while the 3-year and 5-year medians held at 3.0%. Consumers sounded calmer. But the market's pricing of inflation risk, captured by break-even rates, was still firm, with the 10-year break-even around 2.35 as of February 9th, 2026. That split is more important than it looks. Surveys are slow-moving beliefs. Break-evens are real-time prices. When the price is more anxious than the belief, it often means professional money is hedging outcomes that haven't become mainstream yet. And silver lives in that exact gap because it responds to the real rate, the inflation expectation, and the availability of liquidity all at once. So we have a crisis of expectations and a crisis of mechanics at the same time. The mechanics are screaming. The surveys are whispering. When that happens, the next move tends to be sharp, because the market does not tolerate ambiguity for long. History helps, because markets love to pretend each episode is unique, but the playbook repeats. You can find earlier moments where margin changes, volatility spikes, and inflation narratives diverged, and the aftermath was rarely quiet. In 2011, silver ran hard, then got hit by a series of margin increases and forced liquidations. The sequence matters. Price accelerates, volatility rises, margins tighten, forced selling appears. Then, when the weak hands are cleared, the market begins to reprice based on what remains: physical supply, industrial demand, and the reality of monetary policy. The point isn't that 2011 is identical to 2026. The point is the mechanism is the same. When leverage gets unwound in a hurry, price can overshoot on the downside before it finds its footing again. In 2020, markets across the board showed something crucial. When liquidity vanishes, correlations converge. Assets that should behave differently suddenly move together because participants are selling what they can, not what they want. That year taught a lesson that still applies. The most important signal is not the narrative, it's the funding conditions. When funding tightens, the first thing that breaks is the most leveraged positioning, not necessarily the weakest fundamental. Now, in 2026, the same ingredients are on the table again. Inflation expectations are in flux. Policy is restrictive enough to make funding expensive. Silver is uniquely exposed because it is both a monetary metal and an industrial input. It carries the psychology of a hedge and the reality of a commodity. That dual identity makes it prone to whiplash when the macro regime is unstable. It also makes it a magnet for disagreement, which is why the flows can look so contradictory. The reason the pattern is persuasive is that it aligns across layers. First, you see a violent price move that suggests positioning stress. Second, you see an exchange respond by tightening margin, which confirms that stress is real and that the clearing system is protecting itself. Third, you see large flows into an ETF despite the crash, suggesting that some participants interpret the sell-off as mechanical, not fundamental. Fourth, you see major players in Asia taking large directional exposure. Different venues, different motives, same message. This is a regime stress test. Now let's name the players and the levers, because institutions is vague unless you can point to actions. Start with the exchange. CME is a rule setter for collateral and a major futures venue. When it raises margin on COMEX silver to 15% from 11, it changes the cost of carrying exposure for every participant. That affects hedge funds, market makers, commodity trading advisors, and anyone using futures to hedge physical exposure. Then, there are the clearing members and prime brokers who finance positions. When exchange requirements rise, brokers may tighten internal risk limits too. That creates a double squeeze. A trader can meet the exchange requirement but fail the broker requirement, and the broker wins because it controls the credit line. In practice, that means positions are reduced not when the trader wants, but when the broker demands. That's how forced selling becomes synchronized across the market. Next, you have the ETF complex, particularly the largest silver ETF, which became a lightning rod for demand. When roughly $430 million moves into that vehicle in 6 sessions, the market has to reconcile two truths. Price can fall violently, and demand for exposure can increase anyway. That can happen when buyers believe the sell-off is mechanical, or when they are expressing a macro view that inflation risk is underpriced. It can also happen when investors want exposure without the leverage, because ETFs don't trigger margin calls the way futures can. Now add the physical market, because paper flows and physical availability are not always aligned. London Vault holdings at end of January were about 27,729 tons, down around 0.3% month over month. That is not a collapse in inventory. But it's not a surge either. It's a small drift lower at a moment when paper positioning is convulsing. The physical side is not expanding to explain the crash, which implies the crash is not a sudden flood of metal, it's a sudden flood of selling pressure. And don't forget the policy backdrop. When real yields are high, holding metals is harder because the alternative is a safe yield. When inflation expectations rise and the market doubts policy can stay restrictive forever, real yields tend to wobble. That wobble is where metals react first, because they are priced as a monetary alternative when confidence in real returns is uncertain. Finally, consider the cross-market inflation signals. The New York Fed survey is a window into consumer psychology. Break-evens are a window into market pricing. They can diverge for a while, but the divergence itself is information. When consumers are calm and markets are edgy, it often means professionals are hedging tail risk that the public does not yet feel. Timing also reveals something. Margin changes arrive after volatility spikes. ETF inflows arrive into weakness. Large shorts profit into weakness. Break-evens stay firm while surveys soften. Each action on its own can be rational. Together, they sketch a market transitioning from one regime to another, where liquidity becomes the main driver, not narrative. Now we get to the dislocation, the part where two sets of data tell opposite stories. The first dislocation is between survey-based inflation expectations and market-based inflation expectations. Consumers put one-year inflation at 3.1% and held longer horizons at 3.0%. That suggests a belief that inflation is manageable and stable. But break-evens remained firm around 2.35 at the 10-year horizon, signaling that professional markets were not declaring victory. The second dislocation is between paper-silver behavior and physical signals. Paper markets can move with incredible speed because they are driven by leverage, margin, and positioning. Physical markets move slower because inventories, transport, and industrial demand don't reprice every second. When paper prices whipsaw from 121 to 64, the question becomes, did physical supply suddenly double? Of course not. The move is about positioning and collateral, and that means the move can reverse even if nothing about mining output changed. The third dislocation is structural, futures versus ETFs and East versus West. Asia desks were leaning short with billion-dollar equivalent exposure, while Western ETF investors were adding exposure into the slide. One side was pressing, the other was absorbing. That tug of war is not equilibrium. Dislocations like this cannot persist because they create incentives. If paper is too cheap relative to physical demand rises, inventories drain, and premiums widen. If paper is too expensive, supply comes out and inventories build. The trouble is that during a collateral-driven unwind, paper can overshoot far beyond what physical fundamentals justify. That overshoot is what creates the tailwind once forced selling exhausts itself, because price has moved faster than the underlying reality. Now, let's anchor this with evidence, because evidence is what keeps it real. Start with the silver swing itself, from roughly 121 down toward 64. It is liquidation. Add the ETF flows, about $430 million into the largest silver ETF in 6 trading days through February 5th, 2026, including more than $100 million on January 30th during a roughly 27% one-day price drop. In most markets, inflows follow strength and outflows follow weakness. When you see the reverse, it tells you someone is buying what others are being forced to sell. Add the margin changes. On January 31st, 2026, COMEX silver margins to 15% from 11%, with heightened risk to 16.5% from about 12.1%. That tells you the exchange saw risk rising quickly and wanted more collateral against it. It also tells you leveraged participants were under pressure because margin hikes only hurt the leveraged. Add the physical snapshot. London Vault holdings around 27,729 tons, down about 0.3% month over month. That tells you physical stocks were not expanding to explain the crash. Paper did the moving. Add the inflation expectation split. Consumer 1 year at 3.1%, longer horizons at 3.0%, versus a 10-year break-even around 2.35 as of February 9th, 2026. Consumers think in near-term price changes. Markets think in terms of policy credibility, energy shocks, deficits, and tail risk. When those views diverge, assets sensitive to real yields like silver tend to become volatile junction points. Now, what does this mean? The outcome suggested by this cluster of signals is not a single number. Silver responds to real rates, liquidity, and risk appetite, while also carrying industrial demand. That combination makes it a barometer for regime stress, and it makes sudden repricings more likely. If inflation expectations snap higher, even slightly, and nominal yields don't rise as much, real yields fall. Historically, falling real yields are a tailwind for precious metals because the opportunity cost of holding them declines. But if inflation expectations rise while policy stays tight, funding stress increases, and you can get more liquidation before you get the tailwind. That's the paradox. The macro tailwind can exist alongside a mechanical headwind. So the mechanism matters. It starts with crowded positioning. A shock forces price to move. Volatility rises, margin requirements rise, liquidation follows, volatility rises again. That feedback loop is why moves accelerate. It's mechanical, and it punishes the same thing every time. Leverage that assumed the world would stay calm. Margin increases are a key accelerant. When the exchange demands more cash to hold the same exposure, some participants have it and some don't. Those who don't reduce exposure. Reducing exposure means selling. Selling into weakness triggers more margin calls. That's the chain. The chain doesn't care what you believe about inflation or industrial demand. It cares about available collateral. ETF inflows can counter that chain, but not always in sync. Futures set the marginal price instantly. ETF demand translates through the creation mechanism over time. Price can fall even as ETF demand rises because futures are being liquidated faster than the ETF pipeline can absorb. When the liquidation slows, that same pipeline can become a stabilizer. Now fold inflation expectations into it. When break-evens remain firm and real yields wobble, macro funds adjust. Some hedge inflation through commodities. Some reduce risk across the board when volatility rises. Some rotate between industrial and monetary exposures. Silver sits at the crossroads, so it can get hit from both sides. Sold as a commodity when growth fears rise, and bought as a hedge when inflation fears rise. That push and pull is exactly what creates whiplash, and it's why silver so often looks illogical right before it becomes obvious. This is why the gap cannot persist. A paper-driven crash that is not matched by a surge in physical inventories tends to set the stage for a rebound once forced selling ends, especially if inflation expectations remain sticky and real yields soften. But the timing is never clean. Markets overshoot. They test pain thresholds, then they reprice. Historically, what does this pattern lead to? Not certainty, but a set of repeating outcomes. One outcome is stabilization, followed by a grind higher as real yields ease and physical demand absorbs supply. Another is a second wave of volatility if policy stays tight and funding stress returns, creating another liquidation before the longer-term trend reasserts. A third is a regime shift where inflation expectations re-anchor higher and the entire complex of real assets reprices upward, not because of euphoria, but because the discount rate changed. So here are the scenarios framed as conditions. If inflation expectations continue to firm while nominal yields fail to keep up, real yields fall. And historically, metals tend to find support and recover. If inflation expectations firm but nominal yields rise even faster, real yields rise. And historically, metals can remain under pressure longer than people expect. If inflation expectations swing higher and funding conditions worsen, volatility can increase again before the longer arc becomes visible. And if volatility eases while inflation expectations stay stubborn, that's when the tailwind becomes more persistent rather than episodic. What should be watched, not as a directive, but as a dashboard. Watch break-evens for persistence. Watch real yields for direction. Watch margin policy for further tightening or easing. Watch ETF flows for whether demand remains steady after the shock. Watch physical indicators like vault holdings and premiums for signs that paper and physical are reconnecting. When those indicators align, the market's next chapter becomes clearer. One more detail to watch is positioning itself. Open interest can shrink rapidly during margin shocks, and when it does, the market's sensitivity changes. If futures open interest is falling while ETF holdings are rising, it often signals that leveraged hands are leaving and unleveraged hands are arriving. Pair that with the curve. When near-term tightness shows up, you can see it in spreads that narrow, flip, or refuse to widen despite falling spot prices. Also watch real yields day to day. When they stop rising on bad inflation news, that's a tell. That's when the tailwind stops being theory and becomes tape. Now, the divide. There are always two groups in episodes like this. One group watches price and assumes the story is whatever the last candle implies. The other group watches the structure, collateral rules, funding conditions, and where size is moving. The difference is not intelligence, it's attention. The wealth gap in markets often begins as an information gap. Institutions tend to move first because they can see the plumbing. They monitor margin changes. They track flows. They understand that a price move can be mechanical and temporary or fundamental and lasting, and the difference is often visible in the data before it is visible in the narrative. Retail tends to move last because the narrative arrives last. By the time the headline says volatility, the margin change already happened. By the time the headline says inflows, the cash already moved. By the time the headline says inflation expectations, the bond market already repriced. The goal is not to beat institutions. The goal is to see the same signals they see in time to understand what the market is actually doing. This is signal in silver where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether the next repricing happens. The question is whether you recognize the plumbing signals before the crowd notices the price.